how smart families lower their lifetime income tax bills. Most families think that just deferring money in their 401ks, maxing them out, and deferring taxes until their retirement years is the right strategy, but that could leave you paying more taxes for the rest of your life. What we're going to talk today about is maybe thinking differently about taxes and what might happen. The truth of the matter is that deferring taxes till a later time may not in fact be the best strategy, but constantly we see things from the government. Oh, the new limit on 401k deferrals is this, and there's all these ERISA rules for 401k plans trying to limit the amount of taxes you want to defer. And in our mind, I think they're doing themselves a favor and not you. They're always trying to advertise the caps on, oh, you can't defer any more than this, you can't defer any more than that. And my thought is they're trying to get you to defer taxes because they know that there's a big, huge pool of money that's subject to tax at the rate that they're going to tell us later.
I think along those lines, we probably remember that the RMD age was 70 and a half, and then they moved it to 72, and now it's 73 and 75, depending on when you were born. And they act like they're doing this big favor, but they just continue to allow money to be deferred to likely be taxed more harshly in the future. So I agree with you on that.
And I think a common misconception, and something people don't think about, is that there's a partner in your retirement account, and his name is Uncle Sam. And he's going to tell you his partnership interest in the year you decide to withdraw the money from. So you're pretty much at his mercy. So as professional advisors, we believe there's two tax codes. There's one for the informed and there's one for the uninformed. And we've helped clients who make $150,000, $500,000, millions of dollars a year try to think differently about taxes. Right now, we think taxes are on sale. They're historically low, and we think at some point rates are going to have to rise.
So we're in agreement that the uninformed will likely pay more taxes than those that are informed. That's our premise.
So we're here to try to inform you about what we believe is going to happen with taxes down the road. And these aren't, we're not talking about loopholes or anything illegal. This is completely legal stuff. So getting back to the families and the 401ks, retirement plans, whatever it may be, any type of tax deferral annuities, deferred annuities would be in the same thing. Have they done their tax planning? You know, the truth is that right now we are in historically low tax brackets. Does that mean they can't go lower? They could always go lower. But with the tens of trillions of dollars of debt that we have, we think at some point rates are going to have to go up.
I think we're numb to how high tax rates were at one point in time because they've been lower for a while, and 10 years ago, they were reduced again. They were much higher at many different points.
Before the Reagan administration in the 80s, we had 70 and 90% tax rates and a similar debt structure. Probably it's worse today than it was then, but back when we owed lots and lots of money after World War II, tax rates were significantly higher.
Well, even in the 80s, we have a buddy that played in the NFL who earned $250,000 a year. Today, that's probably like $1.5 million. And the last $10,000 he earned that year, he had to pay 70% federal tax, and he played in Ohio. So he got to spend $2,800 of his last $10,000. Now, I'm not saying they're going back there, but I'm telling you, not that long ago, that's where they were.
In many of our lifetimes. We were probably little kids, but still. You know, so we believe that the real threat isn't the IRS. It's the American public not really being informed.
This video is for educational purposes only. Always, always consult professionals before making legal, tax, and investment decisions.
According to research from the National Bureau of Economic Research, the top 1% of income earners legally reduce their tax bite by about 21%. And they use strategies that people don't even know exist. Meanwhile, tax rates are at historic lows and what we call on sale, and people aren't taking advantage of it. So one of the things that I'll talk to clients about is the old philosophy of deferring taxes in IRAs or retirement accounts was, if I'm paying tax at 30% today, in retirement my income is going to be lower and I might pay tax at 15%. To some extent that's happened. There are lots of clients that have money in their 401ks that they were deferring a decade ago or several decades ago. They would have been paying 31 or 35%. They kicked the can down the road to pay a lower rate. And now we can convert at 22 and 24%. We can convert IRAs to Roths or take withdrawals. To me, seems like a huge win. What if tax rates go up? We know that we know they said they were permanent, but permanent only means till the next administration is out.
But to be fair, we have another 3 or 4 year window where they're going to be at these lower rates, where we can really take a look at paying taxes while they're low. The other thing about when they were 70%, we didn't have debt as a country. Now we have lower taxes in 37 trillion, which feeds right into the mantra, you need to tax the wealthy more. Right or wrong, that's the mantra.
So let's look at some strategies that families, whether you're earning $150,000 a year or $1 million a year, they can use while taxes are still on sale. I'll tell a quick story. I've probably told it on other podcasts. I was with a client in the tax office with his tax accountant. It was the tax accountant's last year of taxes. He was retiring in his mid to late 60s. And he said, geez, Joe, why are you converting this IRA money to Roth? And I said, well, he's got millions of dollars of IRA. If he dies, his wife is going to be a single taxpayer and have to take all of this money out in single taxpayer rates. And you know what his response was? I never thought of that. I thought
Which I give him credit for admitting that, but it's kind of hard to believe.
One thing that, and I think almost always this someday single tax scenario is something people fail to think about.
Let's just be fair a little bit to a guy, the tax practitioner. They view their job is keeping your tax bill in the moment, in the year they're preparing your taxes, as low as possible. Right or wrong, our philosophy is how do we lower the family's lifetime tax bill, which is counter to that because that means you have to pay more taxes today to save way more taxes in the future, both for you and your wife and also to the kids. And that's really important to a lot of our clients. The family tax bill is as important as what their tax bill is.
And one of the things we'll tell clients, and this goes back to my early years of saving and investing, if it doesn't hurt, it doesn't count. So there has to be an impact. And when you do planning, it usually means you do something you don't want to do today that's going to help you down the road. So probably something that we skipped over for the viewing public, when somebody dies. So if your husband or wife dies on June 15th or November 15th, you will be a joint taxpayer for that final year. But next year, you become a single taxpayer. And as a single taxpayer, all of the tax brackets are cut in half.
Including the standard deduction.
Including the standard deduction. And the Medicare surcharge taxes are what we call IRMA, I-R-M-A-A brackets. So something we've got to be thinking about. And if taxes are on sale, do you want to be taking advantage of these big wide tax brackets for married filing joint people?
So a live example that hits home. Our father died in 2019. Our mom became a single taxpayer in 2020. Her tax bill, the amount of money she paid in taxes was almost double in 2020 versus 19 on roughly the same amount of income. That hit home.
Right. But fortunately, they did a lot of planning before he passed.
Could have been a lot worse. Yeah.
Another strategy, Roth conversions. So a Roth conversion, a traditional IRA, a traditional 401k, what happens is we defer the taxes. We say to Uncle Sam, I'll make you a deal. I'm not going to pay federal income tax on this money. You let me invest it for the long term. And when I take it out, I'll pay the taxes. So if I put $500,000 over my lifetime into my plan and it's $1.5 million, and I take a $50,000 distribution this year, that $50,000 becomes taxable at today's rates. Next year, or whatever next year's rates are, 10 years from now, or whatever 10 years from now. A Roth 401k.
Let's just start with the fundamental. There's Roth contributions and there are Roth conversions. Roth contributions, you can put as much as $8,000, but it's means tested. If you have a certain amount of income, you're not allowed to do it. Roth conversions, LeBron can do it, right? He making millions, having millions, he can convert just like you and I can. The reason I bring this up is I find clients struggle with that differential. And they say, well, you said I couldn't contribute, but I can convert. And the answer is yes, it's not means tested. There's no income levels or net worth levels.
For any retirement plan contributions, you need earned income. So the retirees can't do it. You also can't use required minimum distributions as conversions, which is a common question that we get. So the original goal of this was we want to see clients gracefully take money out of their retirement plans over time. We know at either 73 or 75, the government's going to make them start doing it. We try to accelerate that and do it earlier. And the option we have is we could take the money out, pay the tax, put it in an account that we pay taxes on every year. Or we take the money out, we put it in a Roth IRA, which if you qualify for the IRS rules, which are basically account has to be open 5 years and you have to be 59 and a half, then it's tax-free. So why wouldn't you put it in a tax-free account?
So to be clear, if they convert 100,000, they can always take the 100,000 back within that 5 years. It's just the earnings of that 100,000 has to be in 5 years, or if you take it out before that, it becomes taxable.
Right. Third strategy, tax loss harvesting. So tax loss harvesting means if I bought a stock at 10 and it goes to 5 and I say, geez, I'd really like to take the tax loss, I can do it. I can't rebuy the stock back for 31 days. So there are strategies and there are certain types of accounts where we can that are specifically designed to tax loss harvest. And it's really about non-IRA gains. It's about your ordinary investment portfolio and trying to reduce the taxes on that long term.
I look at tax losses as an asset. If you don't do anything with them, you're wasting that asset. You know, it's unfortunate that you have losses, but understand it's an asset and there's strategies that you can use to benefit from that asset.
And so what you're allowed to do is you're allowed to use those losses against any gains plus $3,000 on this year's tax return. So if I had a $100,000 loss and a $50,000 gain, I could match the $50,000 gain against the $50,000 loss. And then I get an additional $3,000 and the $47,000 I get to carry forward indefinitely. So I think it is an asset and you can use it for a lot of different reasons. And again, we try to do that for clients. And one quick note about taxes is every client's different. If you're talking to your neighbor, your cousin, or your aunt, your uncle, their situation has no impact on yours because it's like a snowflake. Everyone is so completely different. Fourth strategy, probably one of the most misunderstood, most unknown things to think about. It's called IRMA, Income-Related Monthly Adjustment Amount. When you are 63 or older, the IRS or Social Security will contact the IRS and see how much income you have. And if your income goes up over a certain threshold, there's a surcharge on your Medicare. Right now, everybody pays $185 a month.
$185
a month for for the Medicare portion of their Social Security, or they just get billed if they're not collecting Social Security yet. If your income goes up over a certain threshold, they charge you more for your Medicare. And it could go as high as $550 a month. The brackets are half for singles, not marrieds. And it's something that we've got to be thinking about.
So let me just clarify one thing. So we all know Medicare starts at 65, yet you mentioned 63. And the reason and that's right, the reason is there's a 2-year look back. So when you are 65 going on Medicare, they're going to look back to how much money you made as a 63-year-old. And if in fact you made a lot more money at 63, then you're going to pay the surcharge in the year that you're 65. So it's really confusing, but it's really important to untangle that mess and really understand it and see how it applies and what tools in the toolbox you have to mitigate it.
It's about the right questions to ask, and it's the question to ask your tax people, is this going to affect me? Because we find that most tax people don't really want to get involved in it. Our software does, and we try to pay attention to it, all because a woman came to me before we even knew it existed because it wasn't publicized, and she said, hey, Paul, what is this? And I looked like a fool because I had no idea.
I remember Dad bringing it up because it affected him. And I'm going, what are you even talking about?
Never
he was
publicized.
Fired up about it. And it took him forever to explain it to me.
Here's another thing, state tax arbitrage. We live in a state where IRA distributions are not taxed. Our clients tend to relocate to a lot of different states on the Eastern Seaboard: New York, New Jersey, Maryland, Delaware, North Carolina, South Carolina, Virginia, Georgia. All of them have state income taxes. So they do not tax Roth IRA distributions, at least most of them. So if you're planning on relocating to a different state, in our state, you're better off doing Roth conversions because it avoids the state income tax. And if you move to a New Jersey or a California, the state income taxes are quite large, or New York. So again, the uninformed don't know. They don't know the questions to ask. And the informed can save themselves a significant amount of money.
So I had a client that had a house in Delaware, and he was going to move to Delaware in a certain year and take up residence. And he had pretty much money in an IRA. I asked him to delay doing that for 2 tax years so he'd get the money out of his IRA into his Roth, where in Pennsylvania it wasn't taxed. And it was no big deal because he was kind of in both places. But had he done that unknowingly, there's probably a 5% delta. 5% extra tax that he would have had to pay and wouldn't have realized it until it was too late.
That's a good story. How about a bad story? We had a client who had an uncle that refused to do any planning had millions and millions of dollars in annuities. In our state, there's a 15% inheritance tax to non-lineal descendants, meaning not kids and grandkids.
Nieces and nephews.
And in this case, it was nieces and nephews that got the money. So he had at least $1 million of taxable income. The Pennsylvania inheritance tax of 15% taxed the $1 million of income. And had he paid the $300,000 of income, he would have saved all that money.
You paid inheritance tax on the money that was the government's, essentially.
I mean, there's just and again, it's like snowflakes. Everybody's different, but you've got to be thinking about, how does this tax code, what opportunities are there for me or us, not just for you, but also your family? Because these are multi-generational planning tools that we use. How do we use those for the long term to benefit ourselves?
So switching to the informed tax code is like threading a needle. It may seem like it, it may sound like it as we're discussing things today. And that's accurate. It is threading a needle, but it can be done.
A few minutes ago, I was working on a Roth conversion for a client, and I had to thread the needle between tax brackets and IRMA. It's not difficult. It's time consuming. I should say it's not difficult if you do it all the time. It's probably difficult. I think people do not like math. So start thinking about, ask yourself the question, do I have an opportunity to lower my lifetime income tax bill? What can I do today that may save me money 5 and 10 and 15 years down the road? If you're worried about your kids and you're a multi-generational planner like many of our clients, all the better. I think you have to ask yourself, are taxes on sale? Last I looked, half the population paid about 98% of the taxes. And if we need to raise more taxes, it's probably going to be on that top 50%. Start to think about the two tax codes, the uninformed and the informed.
I have clients that often say, we need to tax the wealthy. And then I tell them, you are the wealthy. And they say, oh, so the real mantra is tax everybody wealthier than me.
Let somebody else bear the burden. I think most of you have worked pretty hard. If you're spending the time to listen, you're probably overachievers. And you should be thinking to yourself, these aren't tricks and schemes. These are just tools in your toolbox that you can lever to try to make the most of what you're going to do. I think the wealthier you are, the more the Roth conversion, it's all about, it doesn't get better than tax-free. The only way it gets better is if you tax the government, not likely to happen.
Here's a fun fact. I find that clients don't know this until I tell them, that you can have depends on your age, but up to $431,000 of income in 2025 and not leave the 24% tax bracket, which is historically a low tax. So even if you're earning $250 or $300, you have room to do some Roth conversions with minimal pain.
And if you have that kind of income, you probably have lots of wealth beside it. So the government, again, the government knows where the money is. They've got a vested interest in your IRA 401k balance is growing because it's just a bigger tax nut that they can attack someday.
We talk about the Sunday single. As they push that number from 70 to 75, more and more of those people that start their RMDs at those ages are going to be single. By definition, they know that. They're your partner. They own a piece of the account. They're going to own a bigger piece of the account if you push everything out to the outer limits.
Because investing is the easy part. It's protecting the wealth that gets complicated. Beyond taxes, there's divorce, lawsuits, legal gaps that can destroy estates. Our next video reveals 3 layers wealthy families use to shield everything. Watch now to see what your advisor isn't telling you. If you make over $150,000 and you want more specifics on tax savings, book a free strategy call below.